Let's now turn to equities, bond yields. Where are they going? Higher and higher or not? For his insights on the current markets, Will Hamilton from Hamilton Wealth Partners joins us now. Will, thank you very much for joining ausbiz.
You're welcome. Hi, Danny. How are you?
Very well indeed. I've been talking to lots of people about bond yields and what the bond market's doing at the moment. So it's quite interesting to read your notes that you're looking potentially at a more tempered inflation outlook and a more positive backdrop for markets in 2024. So can you give us an explanation why you seem to be bucking the trend as those horrible big bond markets keep selling off?
Well, bonds are selling off, aren't they? And I think people are, it's one of the things is when is the next rate cut coming? And one of the arguments you could also put to this is that, growth is strong. It's stronger than people expected, and definitely stronger than we expected. And so at this point, that sort of need for emergency cutting on the back of recession, that R word is still being thrown around a lot, may not be as necessary. And people are looking at now potentially rate cuts at second quarter, and this is in the US, second quarter 2024. But I think the market's wanting to see some sign of when that is. You're definitely seeing some nervousness in bond markets. We didn't like bonds at all. We were not in bonds, and we put a foot in the water in December last year. We increased a little bit in June, and we'll probably be increasing a little bit at the moment, given what we've seen, some of the action in particular last night. But it's interesting, and I think the bond yield curves are also showing where you've got that 30-year and the way that behaved last night, and where that's positioned, 466 approximately against 450 odd for the 10-year in the US. You're seeing that's also telling us they're seeing some growth out there.
Yeah, it certainly looks like it from a macro point of view, because it was a pretty big move last night, wasn't it, off the back of no news?
It was. Look, it's one of the big things is I don't think people really do know what is going on. Volumes are light. But I think one thing we're taking the view of, regardless of what you're seeing in the short term, we believe in the next 12 months, 2 years, you're going to be happy to have taken a position in bonds at these levels.
Right, because the expectation is that you'll see them rally, so you'll make, you're picking up the yields, but you'll also get that capital gain. Is that correct?
Correct. So at these levels, I think that, there might be a little bit of short-term pain, but we're not in it for, 1 month, 2 month outlook. We're in it for a couple of years. However, at some point, bonds will rally to such a point where I think we will exit completely.
Interesting. Now, as Aussie equities, we are typically the market of homes and holes, dare I say. It's a bit trashy to say it like that, but effectively it is, resource companies and banks, etc., financials. Is that the reason why our market is being left behind at the moment?
Actually, someone once used the term theme parks with holes in the ground. But yes, I think that is the reason. Look, if you are looking at a more growth-oriented environment that we've just been talking about with bonds, the Australian market is not a high-growth market, and unlike a lot of offshore markets, and I do think that is one of the key reasons why we are being left behind. So we're marginally underweight on a tactical basis against the strategic benchmark, Australian equities, and that's interesting because we are neutral emerging markets and developed market equities. And the reason being is we just don't see that coverage with respect to the depth of growth companies here in Australia. And we just think that that's why we are going to continue to be left behind.
Can we take a little bit more of a deeper dive? If you're neutral on developed markets, which particular markets are you liking at the moment, even though it's only a neutral weighting?
We are more positive. Whilst we're neutral on our overall developed market stance, we're overweight Europe, we're overweight Japan, and underweight the US. And I think if you just look at the way the so-called Magnificent Seven have behaved, they've left the rest behind. But the one big thing that we are overweight globally is that mid-caps sector down to the small caps. And, they're small caps, especially in the US, they're still very large capitalised companies. And we think they have, they are at GFC type discounts relative to the larger part of the market. And that's one area of the market we really do like. So when we moved from underweight to neutral, we did that actually through mid-caps.
That's very interesting. So it looks like you've got quite a value tilt in the portfolio. Europe, you'd have to say it's a value rather than a growth tilt. Ditto if you're looking at small to mid caps. Are you not concerned that they will be, it's a bit early to be buying them, given that we might see a recession, given that there's a lot of debt refinancing that needs to take place?
In the mid-cap sector, I think we're looking at that discount to the larger cap companies, and we think a lot of that pain's already been had. So yes, there's no doubt if you were to get a recession, you would see a pullback right across the board. But and often mid-caps do come back, because of liquidity, retrace further. But they've also already taken a lot of pain. So I think where we're seeing things, it's not across the board. We use software to make sure we're blended and put the portfolios together. So if certain things are moving, other things, if some things aren't moving, other things are. But at this point in time, we have we brought that developed market equity underweight up to neutral through mid caps.
Interesting. And let's whirl around to emerging markets. Are you including China in that EM basket, or what are the main exposures there?
China is in there, but the managers we use, so we predominantly use North Cape and Skerryvore, are very underweight China, or they use de facto holdings outside of China to get exposure. Both managers have done exceptionally well, but they've also got India right, Southeast Asia made the right calls on that, but they have taken an underweight stance on China. So we've actually had some very good performance out of that part of the world in the last 12 months, and I think their China call has been spot on.